The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
I'm Don Creech, and today is August 5th.
And I'm Perry Sykes. Welcome to the Investor Resources Podcast.
We don't normally announce the day we record these, but today is a special day. We waked up this morning and we thought the world was coming to an end. That's
By all accounts, it was well underway. That's correct.
You were listening to business news over the weekend, and certainly by Sunday evening, you knew that disaster was coming and the economy was collapsing, and you'd be wondering whether or not anything would be left at the end of the day on today, August 5th.
Dust. Yeah, nothing but dust. There's nothing left.
So across the board, starting with across the Pacific Ocean, the Asian markets started, let's say, panicking a little late, but panicking over the Fed's Wednesday meeting. Now, on Wednesday, let's just talk about that for a minute. Wednesday, everything was coming up roses.
Yep.
The Fed had stuff under control. We were going to have a soft landing, maybe even no landing at all.
Landing, right.
And we're going to get interest rate cuts by the end of the year. Hallelujah. Everything's coming up. I mean, just the way it's supposed to.
Everything was right with the world. The economy was humming along. The Fed's a genius. Everything was great.
Until Friday.
Yeah.
Somebody forgot to take their lithium overnight.
Man, I'm telling you.
Their antidepressant. They forgot about it. And they're
apparently that's pretty widespread on Wall Street because it was a lot of them. So there was a lot of them that turned very, very sour. And it was the speed at which the narrative changed was just startling. All of a sudden, the Fed was late. The economy was on the edge of collapse. There was almost no way to pull it out. We certainly were heading for a recession, and that all happened in the span of a few days. It was amazing.
So the catalyst seemed to be a weak labor report, but actually it's not all that weak, and the economy's not all that bad. In fact, the economy's still growing. It's just growing at a slower pace. So those who speculated, as we've talked about in technology, the artificial intelligence arena, all of a sudden they're saying, my goodness, maybe this company's not going to make any profit on all this investment. It's just being thrown down the drain. When am I ever going to see money out of it? That fear rose. The employment numbers didn't excite people because fewer people were getting hired. But we still have 8 million people who are needed by corporate America to fill vacancies.
And let's talk about that for a second, Don. I mean, for over a year now, the Fed has been trying to get unemployment to go up and those hiring numbers to go down. That's been one of their goals with increasing interest rates. They've been waiting for that to happen as one of the underlying things they needed to see to cut rates. It finally happened. And now the Fed says, okay, if we can maintain this, we're cutting rates. And all of a sudden they're too late, though. All of a sudden now, for some reason, it's too late. And oh my gosh, the employment number switched. What are we going to do? It's like the Fed's been waiting for this to happen. They've been hoping this was coming. And now all of a sudden the news is a disaster. I'm not sure where that narrative came from, but man, it hit quick and it spread fast.
It reminds me of the story of the little kid who wants a pony for Christmas. And Christmas after Christmas, he finally gets one. And then Dad says, well, you got to clean up after it. He says, what do you mean clean up? I didn't know that came with the pony.
There you go.
Yeah, so we actually got what we wanted.
There you
but
go.
Now we don't want it.
That might not have been so good. Yeah.
So, but that does put the Fed in a box. And actually the reason that Japan became the first real sign of our employment data being the catalyst for a sell-off,
Hmm.
um, is because of the high level of margin that they have. They investors in Japan, whether they're U.S. investors, Canadian, European, or the Japanese investors, have been benefiting from more than 2 decades of zero interest rate. So
Correct.
if you've been reading any of the financial news, you've read about the carry trade. You're thinking, how do you carry a trade? I don't know.
Right. What does that mean? Yeah.
I take something down to the local market and I can barter with something. I understand that, but this finance carry trade. So that's really what's causing this right now. Why this is not a major meltdown bear market scenario. It has not gone that far, and it doesn't really have the catalyst with earnings that are growing and the major dark pool buyers of U.S. stocks are still buyers in this market. They're accumulating more shares.
That's
So
a big
let's talk.
deal. Yeah.
Let's just briefly talk about what is the carry trade that's causing all of this.
There
So
you go.
let's assume that you have a bucket full of money. You got to carry something, right? Here's a bucket full of
There
money,
you go.
and you take a trip to Japan and you open up a bank account with an investment banking firm. You use your
Mhm.
bucket full of money to buy Japanese yen. Now you're holding the yen in their bank, in your account in this investment bank. Nomura comes to mind. And you go in just normal routine, you say, I think I'll borrow some money against my yen position. You're going to use margin. Now you have more money. What do you do with that? It's costing you nothing, zero, to borrow as much as margin allows in Japan. I don't know what the margin allowance is here. Here in the United States, it's 2 for 1. If you're an active trader, you can get 4 for 1. And HFTs are generally active traders, so they get big margin. So now you have this extra money. You made a deposit, you borrowed against it. You go to the United States where you can get 5% interest.
Mm.
Well, I borrowed at zero and I got a whole bunch of money at 5%. What a sweet deal.
And
Or
it's just essentially riskless at that point.
it
You're
is
buying
at that
U.S.
point.
Treasuries, yeah. So you're not taking any risk here, and you're still borrowing at zero and making 5%. Not a bad deal. But what if it got
You
better?
you could go, and some did, go to Mexico and get 12% instead of 5, a little
Yep.
higher risk, or Brazil and get even more, a little higher risk yet. But let's just stick with U.S. Treasuries, which are a high class security. So now you've got your U.S. account with this borrowed money in it, and guess what? You can borrow on it. So you
Huh.
borrow on it to buy artificial intelligence stocks, or more recently, small cap stocks,
Mhm.
until Japan raises its interest rate and you're on borrowed money and now borrowed time. And the banker calls you, sends you an email and says, you don't have enough collateral in your account. We need you to deposit an additional 25 or 50% today, or we're going to sell everything that you have. Well, if they sell that, you don't have the backup for what you've borrowed to buy in the United States, and you use that to borrow money to buy other securities. This forces those highly leveraged trades to suddenly run to the sell side and say, please take me out. Please just take my securities away from me. Give me anything
Quickly.
for them so I can pay off the bank before I go bankrupt.
It's too
That's what is
expensive to
happening
pony up
right
that
now.
much cash. Yeah, they don't have enough money. They don't want to increase the risk to their hedge fund enough to just load in the cash to keep that a current position. And so the only alternative is to liquidate and liquidate, as you said, Don, now. Everything goes now, and that's how the Nikkei lost, 13% in a day.
Well, and here at home, we basically have been um, lacking buyers in the stock market.
Sure. Yeah.
And if you have a lack of buyers, and there's a whole bunch of entities trying to sell, it's the next lowest price that you can find somebody willing to take a security off your hand. And so
There it
things
is.
pyramid fairly quickly. But
Yep.
for the most part, this is a relatively limited activity. And we should see, as we did this morning, actually, on Monday morning, we saw all those things that were in trouble over the weekend rising. We got buy the dip activity. At the end
Yep.
of the day, short-term traders, some of that has come down a bit, but we still see a lot of higher closing going on. Now, let's just take a quick look at the S&P 500 and just share one of my screens. Share the entire screen. That would be this one. And here what we can see is that this was last week. There's Friday, and here's Monday today. So the market opened up, and then as the end of the day has occurred, it has actually sold off a little bit. The red line through here basically takes us all the way back into March. And so where we are is we've given up 4 months of gains. Market's still up for the year. Even though it's had this big sell-off over the last 3 weeks, we've been working our way down until the Japanese yen carry trades finally collapsed. Now, the problems in Japan have been there for 35 years. It's
Correct.
just
That is not new. Yep.
the investors who've been doing this carry trade have become very complacent, did not believe the Bank of Japan would ever raise interest rates. And when they did, the outhouse got knocked over.
It did. That's what.
That was a polite
That's
way of
what.
trying to say something else happened.
Yep. That's exactly what happened. And the yen strengthens, and all of a sudden that carry trade. You're carrying the difference between yen and whatever currency you converted to. Say it was the U.S. dollar, and all of a sudden the yen side is getting more expensive by the day. And that's where the problem comes in. And that's why the adjustments get made. That's why you get the margin call. And that's why if you're not interested in actually being long, you have to leave, and you have to leave today. You don't get an option. You've got to leave fast or pony up significant more funds in your account.
So here I just put up the NASDAQ 100. And so today's activity is back to February lows and January highs. And it had the same kind of day. It opened higher. And at the end of the day, there's a little bit of selling. It's not as heavy as in the S&P, but there's interest in buying at these prices. For a lot of people, they looked at it, let's say Nvidia, and said, "Man, that's way too expensive." Or they heard the news about Warren Buffett selling his share of Apple, and all of a sudden, people are saying, "Oh my goodness, Warren Buffett's getting out of Apple. This can't be good news." Except he hasn't sold out of Apple. He's just taken some profits off the table.
He lightened up his position. He still has $84 billion worth of Apple. It's not like he does not have a lot of confidence in that company. It was just time to take some profits. And as Warren Buffett will do, he sold off about 55% of his position, but he didn't sell Apple out. He's still got $84 billion investment in that company. I would say he's probably still feeling pretty good about owning Apple going forward. Otherwise, he wouldn't still have it. So yes, he lightened up. No, he did not head for the exit.
Yeah, so Apple's an interesting company at the present time because they are incorporating artificial intelligence on their iPhone rather than in their own system that people access the system.
Right.
And I think their argument is this is going to give individual users more privacy control over the use of artificial intelligence instead of relying upon Microsoft or Google or somebody else, where you don't have a lot of control about with the application and how it's going to collect your data. So
sure.
If we look forward with regard to Apple, one of the issues is whether or not this is actually just bringing sales forward out of future quarters, and we'll see problems show up with earnings sometime next year. That's one of the speculations about the way they're entering the AI or applications as opposed to some other companies. But
Yep.
I don't have the market closing data, but as we were looking at the market earlier, the S&P was down about 8% from its high, but it's still up 10 for the year. The NASDAQ off almost 12%, but it's still up 7 for the year. This is normal. This is a
Correct.
normal market correction in a bull market. This is not a bear market. But over the weekend, if you were flipping through the online blogs, you
You
would
bet.
have found people who were promoting economic disaster and Armageddon, particularly in light of what's going on in the Middle East.
There you
Uh,
go.
certainly enough to be generating some fear. Small cap stocks, just like the charts I just showed you, they've dropped back down into their 2-year trading range. Uh,
Where they've been for a while. You're right.
so
So,
yeah, it's two almost. I don't know, it's coming up on 3 years now. If we take this little
yep.
blip out of the last month, it's almost 3 years that they've just been up and down, up and down. And you think you're making money, and then all of a sudden it washes its way out and goes back down to the bottom looking for technical support. And then it muddles around and it rises. And then it hits the ceiling and it reverses again. And that's kind of the way the market functions on a regular basis with
Yep.
what small and mid cap stocks haven't been able to produce, except in the long term, is a consistently rising trend. For the small mid cap size, it's a very slow growth cycle. Suddenly it gets a spurt, and then it goes back to this long, drawn out slog of getting ahead. Every now and then they get a second wind and they spurt ahead, and then they go back to saying, I couldn't do that very long. I got to go back to walking. I can't.
There you go.
The jogging was tough enough, but running, that was really hard.
Forget about it. Yeah. Can't do it.
But what we're looking at with increasing volatility, we really haven't seen this kind of volatility since the COVID years. That spiked really heavily. We saw this back in 2008 with the great financial collapse. But they worked their way out, and that's basically
Right.
where we are today. We've got a sudden catalyst coming from a foreign country, the Japan Bank of Japan and the carry trade. They've decided zero interest rate is not good for their economy. They are slow learners. A lot of this would not have
Took a while.
happened
Yep.
if they had allowed the market to collapse and self-correct back in the early 90s. And they just simply did not want to bear the pain
Yep.
after having 20 years of a bull market. The thought of a bear market that they could control was untenable. But now, my goodness, they own almost all the Japanese government bonds and they own half of the Japanese stock market. If they
Equities.
want
Yep.
to sell, they're the buyer. That's a problem.
Nice, huh? Yeah, that's a broken market. That's right. That's a broken market. So it's going to take a while, but it's going to rebalance itself as far as the rest of the world is concerned, and it's just going to take a minute to let that happen. It's going to happen relatively quickly. So the volatility from the carry trade collapsing should self-correct in relatively short order. It may not be done yet, but it's going to happen, and it's going to happen quickly because in general, the bigger investors don't want to put more money into that trade. They're going to be going the other way. So it's going to be liquidate quickly, and then move on to somewhere else with those funds.
One of the bailout options, which is on trading on the market or over in the overnight market anyway, was bond investors who are basically showing in through their trades that they expect the Fed to make
Close.
an emergency intervention and lower
Yeah.
rates this month rather than wait for September. Problem with that is if the Fed does it, they're basically going to admit that everything they said last Wednesday was wrong.
Right.
And the Fed does not like being wrong, at least not
Nope.
publicly.
No,
And if they
that's not
did
likely.
that, it would cast doubt on their credibility across the board. And the assumption around the world would be, Well, if the Fed's doing that, the U.S. economy is really in deep trouble because
Right.
that's when the Fed cuts rates. They're trying to re-stimulate an economy that has slumped, and so far they don't have the data to justify that. So we don't think the Fed's going to make any cuts until September.
Yep.
And the second bet is they won't make a 25 basis point or a quarter point cut. They'll make a 50 basis point, a whole half a point. And I saw some reports that some traders are expecting they still might get as many or the equivalent of 6 rate cuts over the next couple of quarters.
Right.
That's a pretty optimistic assumption about what the Fed is likely to do. Inflation is down. You get rid of housing and the housing data, then inflation is down. But inflation in the grocery store is still up.
Still there. You bet.
So the Fed has done to itself what I've written about for years, painted itself into the proverbial corner where there is no door. Whatever they do to get out, they're going to end up with dirty feet.
Correct. And it's much more likely between now and the next meeting, instead of raising rates, they're going to get out there and talk about how, okay, all of their targets have been hit. They're definitely going to cut rates at the next meeting. So everyone knows the rate cut is coming, and maybe the markets will take a little break here and say, okay, we can stop panicking anyway. We're within sight of the rate cuts, and it's probably not going to be one. They're going to cut a few times. I don't know if it'll be 6, but they're going to cut a few times, and that may be enough to calm things down as the carry trade normalizes. That may be enough to soften things up, and then the Fed will continue as they have after the next meeting.
Well, thanks for your time today. You want to hear more? Subscribe. Right down here at the bottom of the video is a subscribe button. That way you'll be kept up to date with all of our new posts. If you want to talk to us about your portfolio and how we look at it versus a standard pie chart, balance, own everything, and pray that something works all the time, somewhere, sometime, someday later, something's going to work. I pray it will. Instead of doing that, own leadership and get rid of the laggards. Contact us. Our email and our free 800 number are on the screen. Have a great day. Remember to subscribe.